Good afternoon. Welcome to the TheoTRADE Afternoon video. I'm Blake Young. Today is April 15th, 2024, and we're going to discuss consumers are tired and retail sales numbers clinch it. To start, let's look at the big picture. Looking back at the last few years and today putting in a new record high, we can see that there's a lot of bullishness in the market. But the question is, what happened in these corrections? What happened in the corrections in 2020 and 2022, and all the way back here we can look at the corrections that we saw in 2008, even all the way back to 2000. Were there any early indications of what pulled the market back down? And I think one of the main things is to remember that GDP, gross domestic product, is 65% consumer spending. And so when we get a report like today where we have retail sales, and retail sales are showing us that we have lower demand, lower spending from consumers at the retail level, it is an early indication that we're seeing a slowdown. But there's more to it than just that. Let's take a look at the report and let's look at some of the data that we've seen already. Starting with retail sales through Forex Factory, you can see that we came in at negative 0.8%, so a significant decline in retail sales total month over month. You can see that this is a big negative, not just barely crossing to zero or negative from the previous month, but a big negative, negative 0.8. But one of the other things I want you to notice, it's the lowest level that we've had in retail sales going back to April 2023. Additionally, if we look at the revisions, we already revised last month's lower. So it was being reported at 0.6, and we've revised it lower to 0.4. So the growth that we had here wasn't as high as what we're seeing here. And if we look at all the revisions, especially in the last couple of years, you can see most of the revisions, if not all, were negative. Revised lower, revised lower, revised lower. The little blue, dark blue line on the light blue line, revised lower, 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 one higher, lower, 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 lower. So when we have revisions over the last couple of years, almost all of the revisions have been lower. So retail sales generally look better than what they really are, is what that tells me, that most of the revisions are going to be revising worse. And so this negative 0.8 could be worse than negative 0.8. It could be negative 1 or lower, and we could be looking at pushing this through April 2023. We could be looking at multi-year lows in retail sales. But it's, as the saying goes, the devil's in the details. What drove retail sales lower? Was it everything? Or was it just one segment of retail sales? Going to census.gov, the direct source from the government report, you can see advanced monthly sales last month, even though it was revised lower. Remember, it was already moved lower. So it was about 709 billion. Now it's 706. And then this month came in at 700. So we've seen more than a significant 1.23% drop from November to January, and a negative 0.8% drop in the month from December to January. If we look at the percent change in retail sales and food services up here at the top, you'll notice that what we're seeing that went super negative in January is automotive. Everything else was also, total was down, non-automotive was down, but automotive is what is pulling it down the most. As far as ex-auto, non-automotive included, we were still down negative 0.7, and here we are, automotive pulling down the entire number. So that's a significant drop, but it's not just automotive, but automotive is the big mover. And automotive was small here and significantly down here. General merchandise was flat. It really wasn't anything significant. A couple of other things to note. Looking at percent change based off this last report, it's also important to note that we had a negative 7% drop in furniture and home furnishings. Those are big ticket items. Building materials down negative 6%. Gas stations down 7%, and that can be due to lower oil prices, but it's that automotive. So retail sales, food and food services up 2%, and we're just looking for that number to tell us what we really are seeing going on in the market. If we look at the trends and we focus on the motor vehicle part of this retail sales, are there ways we can determine what is going to happen next? This is a major drop from the highs to the lows. When we look at automotive, we've created wider patterns here. So all the way from 92 to 99 to early 2000s, we can see the pattern goes up from 79 million down to 60 million, up to 66 million, down to 71 million, back and forth, 78, 70, back and forth through here. So we're running in, maybe a 17 to 20 million dollar swings until recently. Now the swings are going from 114 million all the way up to 140 million. So we've increased the swings and increased the ranges on these swings and retail sales of the automotive industry by almost double. But in addition to that, we can track and do technical analysis on the data through here as well. Even though we're making higher highs, higher lows, higher highs, higher lows, if we look to the point where we saw it break through the low report, and we can go and look at the actual data here at the bottom, but I'm just looking at this chart, we can do charting on the technical analysis on the retail sales. So January 2000, we created a low. We popped back up, and then we broke through. If you look at the actual number, we broke through from 58 and dropped below to 58 in November of 2000. So we could look at November of 2000 and say, what happened to the economy when we changed the trend? We widened out, created an expansion pattern, and stopped advancing from retail sales. We already know what happened in 2000, so we'll hold that thought for just a minute. So November of 2000. Additionally, we created this low in January of 2007, and then made a new low, broke through the low in January of 2008. We made lower lows on retail sales in the automotive sector. This is the big ticket item. Consumers, if we're tired, if we're worn out, if we don't have the ability to borrow money, we won't buy cars. It's that simple. And we won't buy big ticket items. And so if cars are breaking through and creating lower lows, technically speaking, we can see the 2000, we led it in November of 2000. We led it again when we made this low in January of 2008, and then we made lower lows, lower lows, lower lows all the way through here. And then we made higher lows in January of 2010. Over here, when did we make lower lows? February 2019, and we broke through that February 19 low, if you want to look at that low price of 89 million, and we broke through there in March of 2020. Coincidence? I don't think so. So as we're watching this, we'll get to this most recent one in a moment. But if we're looking at the month-to-month time frames, this is a monthly chart, and we're to look at those reports, look at November 2000. That's when we broke support, traded through here, and the automotive sector led or signaled based off of retail sales that was a breakout. And that literally was the break of the lows in the same month. The automotive broke through its lows, and we saw the crash that was part of the dot-com world. We scroll forward to 2008. Remember, January 2007, we created a low. In January of 2008, we broke that low. Now, this is December. There's January. So we did break through shadow-wise, but then January, we confirmed it with a close below, and that began another massive sell-off. If we went back and measured those percentages of the drops from the time that the automotive sector retail sales broke through the low to the low, that was a 41% decline after the breakout. And from the high in January or the 2001, it was 50%. Okay, so scrolling forward here, what did we see? Confirmation-wise, January of 2008 to the lows, 51% decline. From the highs, we saw a 57% decline in the SPY. Now, as we scroll forward, we actually can find a little bit of a blip in here as well, but I'm going to move forward, and we can talk about the 2020, and we can talk about current. So when we saw the 2020, we went from the lows at 89 million to 80 million in March of 2020. So where's March of 2020? There's February, there's March. Now, we know that we pumped the market full of money and it reversed sharply, but that still set us up to see that drop, 14.6 from the highs in that corrective wave. We saw that drop down about 35%, but we're going to dig into the automotive here in just a second. Now, we haven't broke the lows. Go back one more time to the data. as we're looking at the automotive retail sales, the last major low, and we're just looking at these numbers through here. If we're looking October, November through January, the lowest value that we have there, we'll scroll down and you can look at the data. Maybe it's a little bit easier than trying to zoom in on these numbers. But we're looking at that January at 117 of 2022 and 2023. So you go to 2022, 2023, you can see the lows. January 2022 is 114, 117. So if we get below 114, that would be the breakout. We went down and tested the 117, but we didn't clear it. We bounced back up, and you can see the numbers through here. But if we get through 114, that lower low, which would associate with a breakout through here, 114, it's hard to get that number to line up exactly, but it's 114, we already have the number. If automotive retail sales break through below 114 million, are we going to see a 30, 40, 50% correction in equities? Well, what happened to the individual automotive stocks? And we'll do this quickly, but let's take a look at GM, Ford, and we can even look at Toyota Motors. As we're looking at this, again, the same time frame, 2000, what are we looking for? There's your breakout, there's your acceleration. The automotive industry in 2000, at the same time frame we made the new lows. GM continues selling off all the way down, and according to this, we dropped 98%. 98%. Now that's a massive sell-off, so let's focus on some of the more recent ones. Let's look at 2008. So as we look at the same time frame, January of 2008, that continuation, that was about an 86% decline. If we look at 2020, when we look at GM for the view of 2020 from the breakout in January, we did see it drop down 53%. We can do the same thing with Ford. We get an entire month report to help confirm what we're already expecting to see. There's your January. We see it pop back up. Ford does climb back up, but then falls all the way down 72%. We look at 2008. 2008, January. Same time frame, and Ford falls 82%. We go to 2020. 2020, March 2020. Now this was the low for these guys. This was not quite as good as General Motors, but it did continue to sell off. You can see there's your breakout of your support level, and it did drop 50%. It was just that it already had sold off as those numbers pushed through that low. So as I'm looking at these, I'm seeing real opportunity if we see retail sales break through 114 million. Even on taking a look at Toyota, the one that's have outperformed, even if we look at Toyota and go to January of 2000, there's your January 2000. We did pop up, but we did fall back down, and we did find a low all the way over here for a decline in Toyota of 52% after the report, after the decline. As we're looking over at 2008, again, we're looking at that January 2008. There's your number. Pops up a little bit, 7%, but falls back down 50%. So retail sales making new lows, specifically to the automotive industry, specifically to the automotive sector, you can track that and see those same numbers. Again, we saw the spike down. There's your March. We dropped down a total of 10%. But that was because we had that pump of increased liquidity and all the excess pandemic dollars that turned the market around. As we're approaching this next move, could we see Toyota, Ford, and GM, if they break through their lows, retail sales wise, are we going to see a decline of 50%? Are we going to see GM drop from $38 or $40 down to $20? That would just be going back to retest the 2000 lows, the 2010 lows, the 2012 lows, the 2005 lows. I think that gives us a real opportunity to look for a short or a bearish trade in GM. Ford is going to be something similar as we look at this and say, do I think it can drop from $12 or $13 down to $5 or $6? And again, that doesn't even have to hit the lowest low. If it goes down to 4, we're talking about a 66% decline, and that doesn't even mess with this price action over here. As we're looking at Toyota, one more time back through the other side. One more time. There we go. Toyota is all the way up at 228. We could wait for confirmation, let it break through this monthly low. Toyota's doing great. I do think Toyota may be able to ride this out because of their advancements in technology. But even so, if it falls 50%, 228 brings you down to 114. That would bring you through the lows and take you back all the way back to the 2020 levels, the low shadow of that 2020 low. So they all technically line up to a 50% correction of current price is going to take you back to the 2020 lows. All of these are set up if we see retail sales fail and break through and create a technical lower high, lower low, there could be a real opportunity to go short. I would also consider shorting Tesla or taking a bearish position on Tesla. We just don't have the history to be able to really track that into the 2008 where it's being treated like an automotive company. It's primarily treated like a tech stock. But could we see a similar pattern? Could we see a 50% correction in Tesla? Yeah, we've already had a big correction and a drop in retail sales of automotive sales. Could be looking at Toyota, Tesla, GM, and Ford all cutting back about 50%, which would put Tesla on track for about $100. We won't know that for another month. We won't know that for at least another month because it could take more than that to do that. So if we go over and take a look at GM one more time, GM up here near these resistance levels after earnings. If retail sales break through support, could I start selling call premium up here at the top? As we look at call premium up at the top, we know that we have resistance, 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 resistance. We know that equities are pushing to new record highs, and GM is not. We're currently in the implied volatility of about 36%, so it's not cheap, so I don't want to just buy an out-of-the-money put. It's not expensive, so I'm not going to make a ton of money on selling the vertical, so this could be an opportunity to sell premium and also buy an out-of-the-money put. So if we look out here and say we're talking about next month's report, which means we would need probably months and longer, what if we were to sell next month and buy out further for options? If we sold next month's call premium and sold a delta near 40, a 39 delta, a $40 strike, we could sell the 40, buy the 41, and we're going to get paid about 30 cents. Now, this is not an expensive stock. So if we're going to collect about 30 cents here, and if we went out another month and were to look out, and you'll notice the applied volatility slowly moves up higher. So we do know that we're paying a little bit more to buy an out-of-the-money put. But if we're talking about a drop that could see a 50% correction, we can buy out of the money if we're going to see that directional move. We know we're getting paid 30 cents. If we want to create this in a way that will create a calendar, then we could sell a delta near 22, 36 for April, and then we can buy one more month out to May. Now that's going to put us pretty flat. It's going to give us an 8-cent debit. If I analyze the trade, it says by our front month expiration of March, the vertical has about a 35% chance of getting in trouble with a 65% chance of not losing. Now, the reason why I'm saying it that way is this is just the front month. After this front month occurs, and if we're looking at later expirations, if I look out 2 expirations, after that short vertical is gone, this is our potential. So for $108 of risk, we have a 65% probability of not only making some money, about 50% return on risk, but if we give us more time all the way out to April to hit that calendar, we have the potential to see $108 for $108 risk and a cost of $8. As we continue moving, we could actually see the long put continue to move in our favor, and then we'd have something that could be an in-the-money long put over time, and that would be something below 36 all the way out into May. Now, this is not a high probability trade as far as we're going to get the big sell-off, but it is a high probability trade as far as not losing. We have a 2-to-1 probability of not losing and about a 1-to-1 reward risk ratio. So the layout does set us up for a high probability trade with a good, better than expected edge in that trade. And this could be across the board again for all automotive stocks. We want to see that we're going to get that premium. We want to make sure that we're going to see that the retail sales do break through that low for this thing to play out over the long term. But I do think this is the time to take that bigger picture and that bigger trade. And as a quick reminder, again, it will require a break below these lows. And I actually misstated. I said millions because I was looking at millions of dollars. It's actually thousands of millions of dollars. So when we talk about this 114 that was the low, we're actually looking at $114 billion in automotive sales. So we can wait. The confirmation is a break below and a trade below that 114 billion. So as we're looking at that number, that's a significant decline from the peak. We're talking about going from these peaks in the $150 billion down to $114 billion. We can wait until it confirms because, as you can see, it oscillates. There's seasonality. Up, down, up, down, up, down, over and over and over and over and over again. We need to break through the support before we really trust that as a significant breakout and ding to the economy. But consumers, when they stop buying cars, they stop buying furniture, they stop buying big ticket items, that is when we know that they are either unable to buy or unwilling to buy because of concerns of the economy or lack of funds. And two more things to look at before we wrap up. If we look at the number of cars transitioning into serious delinquency, meaning 90 days or more late, 90 days or more late payment, last December, we were at the highest level that we've been at since the 2008 financial crisis. And so we know that the cars are going into delinquency. We know that people are not making their payment on their cars. We know this is the highest level it's been, and that's a problem. One other thing you can look at is the ETF for the automotive industry. And you could use something like CARS, C-A-R-Z. The problem is this doesn't have very good options to trade. So I'd probably keep the trading option-wise to GM and Ford and Tesla, Toyota Motors, and even Honda. But this could be a confirming signal as well. Let it break through the lows, break through support. It's just interesting to see that consumers who are the blood force of the economy, the life force, if they don't have money to buy cars, and cars have statistically shown all the recessions when they broke through the last low, and we are seeing the delinquencies have never been higher since the last major recession in 2008, are we setting up for that next default in cars? And we don't have to sell all the market. We don't have to sell all the tech sector. We don't have to believe that we're going into a massive recession, but it does give us an opportunity to trade bearish positions and collect premium on GM, Toyota, Ford, Tesla, and Honda. Well, that's going to do it for me today. Have a great day, everybody. We'll look forward to talking to you again next week.